Sanjay Dongre, who's the Senior Vice President Fund Manager at UTI AMC, also joins in with his perspective on the market. Sanjay, what are you doing? What is your approach and towards managing your portfolio in this sort of a market environment right now?
Yeah, if you look at the market valuations, today they are quoting at about 12.5 times 1 year forward multiple, while the, if you look at the average levels at which the market had quoted in the past was about, in the past 5 or 10 years, it's about 14 to 14.5 times 1 year forward multiple. So clearly today the markets are inexpensive, and that gives great hope for return going forward. But if you look at the again market or the various sectors and stocks which are quoting at various valuations, it is clearly the two halves are there. One half where the sectors are quoting at all-time high valuations compared to the average valuations at which they have quoted in the last 5 years, while there are other sets of stocks which are quoting at all-time low valuations compared to what they would have been quoting in the 5 years back. So there are clearly two sets of stocks are there in the market, and the way the things are happening, I mean the way the market has corrected and the way the valuations have become attractive, I think at the moment the inclination is more towards buying the stocks which are quoting at lower valuations by getting rid of the stocks which are quoting at all-time high valuations. So that is how the approach is going to be going forward.
You do not look at distressed names at all right now, because there could be a strong chance of some of these playing a catch-up, Sanjay?
It could be, but then we wouldn't. I mean, even if you look at some of the distressed names, that's just purely based on the trading, basically. I mean, you won't be looking at making those stocks as a core holdings in your portfolio. Maybe one could be looking at those kind of stocks purely for the trading purposes.
What is the current view on the oil and gas space, and would oil marketing companies be of interest?
If you look at the oil marketing companies in terms of valuations, be it price to book multiple or price to earnings multiple, I think they are quoting at pretty low valuations compared to what they had quoted in the past. So in terms of valuations, they are pretty attractive. The only thing is the concern is the subsidy burden. Now, if the steps are being taken to reduce the subsidy burden on oil and gas companies, then to that extent the certainty about their earnings goes up, and therefore the multiples would go up. So we'll have to really wait and watch whether the steps are being taken to reduce the subsidy burden on these companies.
Are you adding banking stocks to your portfolio, Sanjay? Because as we were talking about it, even some of the PSU names are still, even if they may not be trading at the lows, are trading at sub-book, at times even 0.7, 0.8 times book. Are you adding any PSU banking names to your portfolios?
Yeah, we have. In the recent past, we have added we have increased our exposure to some of the PSU banks. Look, the PSU banks in terms of valuations are again attractive, and most of the banks are quoting at valuations of less than 1 time book. The only concern which market is having is on the asset quality. But we believe that the worst for the economy is over in terms of GDP growth. And going forward, the GDP will be in the process of bottoming out once the interest rate cuts starts happening in the economy. The only thing is this interest rate cuts will happen over a period of time rather than the shorter period of time. And therefore, the recovery in the economy is going to be a lot more gradual than one would have expected. But as the economy recovers, I think the asset quality deterioration which was happening in the past, I think that will stop. And if that deterioration stops, then I think the outlook for these PSU banks will improve. And I don't see any reason why they should not be then quoting at least 1 time book multiple or slightly higher than 1 time book multiple. And therefore, I think if you look at all these banks from slightly medium-term perspective, I mean maybe 18 months to 24 months perspective, I think they are quoting at good valuations to enter into.
Okay, what about some of the cap good names? Because in today's session, Voltas, after just about an okay set of numbers, is rallied 13%. There's some traction in other select mid-cap capital goods stocks as well. Never mind what happens to a BHEL and an L&T. Are you looking at capital goods, large caps or mid caps?
So right now the concern for the capital goods stocks is that the capex cycle hasn't turned upside on a higher side, in the sense that capex hasn't really picked up in the economy, and therefore order inflow for all these companies had been significantly lower compared to the past, and therefore the order book position of these companies are depleting every quarter. And going forward, that is going to impact the revenues of these companies. So really, unless the policy uncertainty ends or the interest rates gets cut by a substantial amount, the capex cycle is unlikely to rebound. And in that scenario, capital goods may not look attractive from the near-term perspective. But yeah, from the if the interest rates, as they get cut in the economy and as the economy recovers, I think even the capex cycle will pick up in the economy, and therefore those stocks will be a good holding from medium-term perspective, but not from the near-term perspective.
Right. What about cyclicals, commodities? What's the approach there? Do you think this turn in the cycle or this downtrend perhaps throws up an opportunity for some of those names?
Look, cyclicals mostly, if I talk about, say, metal stocks, I mean, those are the global commodities, and as long as the global economy remains in a low growth trajectory mode, like we have seen we have seen in the US economy or in the European region, we have we have a debt crisis, and therefore the growth is actually is on the negative side. So as long as the global economy remains subdued, I don't see any reason why the global commodity prices will rise. Basically, on the contrary, this global commodity prices might remain subdued or might decline. So as long as the global economy remains in a subdued, I don't see any reason why one should be looking at metal stocks or cyclical stocks.